Trading options involves risk. Visit the OC website to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money, but you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, that's exciting. Let's get going. So, as I was saying, semi-boring day in the markets, not much going on. We're, tugging along those highs and not, well, actually, where's the other chart? Let's look at the other chart. That one. So everybody look at the daily. Everybody's up around their highs. Here's the Dow, here's the S&P, the NASDAQ is still a bit below. The Russell is back to testing the highs it had back in March. If we go further back, zoom out further, everybody's come up to this point and basically paused on the whole. And that's where we are. And if we look over at Japan, Japan's done that too. Europe's doing actually better. They're actually moving higher. And Germany itself is breaking out and up. So maybe we got more gas in the tank. We'll have to see what happens. It shall be interesting. Oil's been interesting today. Yeah, well, not the weekly version of it, but on the hourly version. We got up to here. We had the API report last night. That gave them a boost. But the EIA report, which came out just 10:30, was not supportive. We discussed that in chat. And more importantly, so what were we looking at in chat? Is this May 28th? This is the old one. This isn't today's. That's annoying. Imports average, commercial crude decreased by 5, gasoline increased by 1.5. All right, so here's the thing though, while we're looking at it. Last week, which was pre-holiday, and we had this discussion in the last webinar, so May 28th, So May 28th was the last report, was a Friday. It was only through Friday. And what I said then is I said, well, this is a holiday weekend coming up, and you can't really judge, exactly what the driving is, but usually before May 28th, people are filling up. Motor gasoline increased by 1.5. Oh, damn calendar. So motor gasoline increased by 1.5. But what happens before holiday, it's not about the drivers. Drivers don't pull up to refineries and get gasoline. The gas stations expect to have a lot of holiday traffic and people coming in to buy gas. So ahead of the holiday, the gas stations they don't order more trucks, they get their tanks topped off, basically. They want to make sure they're fully stocked with gasoline. Gasoline is just like anything you put on a shelf, right? You want to make sure you have it to sell. So before a holiday, they top off their tanks, and they tend to be as full as they're going to be before a holiday. Now, what does that mean? That means if the holiday sales, in fact, disappoint, the gas station the next week is not going to order more gas. But we don't know any information. That's why getting a report, and this is a big mistake that traders make, is because they get a report and they don't consider the timing of the report. The fact that you got a report, we got this report last Wednesday, and it only went through the previous Friday. So we got it here on the 2nd, and it was only accurate. I'm sorry, we got it on the 3rd because it was delayed a day last week because of the holiday. We got it on the 3rd. It was only valid through the 28th. Didn't tell us anything about the weekend. Plus, you don't know what time on the 28th it was valid till. But what we do know is that ahead of the holiday, gas stations stock up on gas. So you would expect a large amount of gasoline to be drawn from the refineries. That's the customer of the refinery. It's the gas station. And here you go. Total motor vehicle gasoline inventories increased by 1.5 million. So it increased by 1.5 million ahead of the holidays. Oh, son of a bitch. Pick a time. Hang on. Pick a time. 5 p.m. Yeah, go for it. Have fun. Well, how does that go? Go ahead and restart then. All right. So again with the calendar. So we're not learning much from this report dated May 28th. I'm showing you the week ending May 28th on Friday, because all we know is that they didn't surprisingly draw a lot of gas out of the refinery. If they didn't draw a lot of gas out of the refinery, what does that indicate? It indicates they probably had plenty of gasoline. It also indicates that prices for gasoline were spiking up, or it doesn't indicate that, but reflects that. There's a whole, cause and effect sort of thing here. But just ahead of the 28th, gasoline prices had spiked up significantly from $2 to $2.15. I don't know how far back we can go. But yeah, so hovering around $2, then it suddenly shot up to $2.15. So if you run a gas station and you have gas, and they suddenly tell you, oh, now it's $2.15. Now and that's 7% more than it was the week before. So do you want to buy more gas, 7% more? No, not unless you're sure you're going to sell it, right? You don't want to stock yourself up with expensive gas. You want to stock yourself up with cheap gas. Gasoline stations tend not to play the games of deciding when they're going to buy. They don't try to game it. They should a little bit, but it's, I've had that conversation with gasoline people. They're like, that is way too complicated for me. Should be a service that does it for them. But anyhow, so there's several things being reflected there. The gasoline was $2 or so. It went up to $2.15. Maybe that caused them to hesitate in buying, but for whatever the reason. So then you say, okay, that's making a bullish case for the gasoline. So then you look at the report and you say, okay, well, that means that the next week, that's this week now, that means the next week we would expect to see a draw because they didn't get enough gasoline the week before the holiday. If you're trying to make a bullish case, that's your only bullish case, is to say, well, there was no drawdown in gasoline the week before the holiday, but therefore the week after the holiday, there has to be. And now also, because we know that the next week, the next report starts on the 29th. So the next report starts on the 29th, which is Saturday. That means the entire holiday and the post-holiday is being captured in this next report. So certainly, if they didn't buy gas going out to the vacation, they must have bought some on the way home. Nobody went all the way there and back and still didn't buy gas by Friday. That's highly unlikely. So for sure, if you're going to be bullish, you're going to see the gasoline numbers reflected there. That's what leads to today's disappointment, because when you do get today's report, and here it says May 28th, and we refresh it, yeah, June 4th. How's that for perfect? All right. So then we refresh it, and we go to June 4th, and we see that oil inventories decreased by 5.2 million barrels, which is what you expect. But then what happened? Gasoline inventories increased by 7 million barrels. What the hell happened? That's a disaster. Where's the demand? There was a build last week around the holiday. There's a build this week after the holiday. That is a disaster. There is no accounting for that at all. It does not support the bullish case. Therefore, we get there. Oh, that's a top trade. That's not even the right thing. Damn it. We'll talk about that. Come on. See, I was going so smoothly and then got stuck. Therefore, getting back on track. Oh, don't even get me started on this. I'm just have to talk about that because it's happening today. But kidding. It's been very nice we haven't focused on global warming for 4 years because, frankly, it's very bad. Okay. Where do we talk about the gasoline? Oil. So then I said there's a big, nice 5 million barrel draw in oil, but that was the week ending June 4th. So this was our big holiday weekend. The week before was a disappointment. This was supposed to be big, and now it's disappointing too. Certainly not supportive of $70, which is my average short after adding 2 more at 70.50. So in other words, we got up to 70.50 earlier in the day, and obviously since our basis was 60. Our basis was 69, I think. I think our basis was 69 on the ones that we had. And so going to 70.50, all we're doing is adding it because we had the conviction on this one. And, but now we took off 2 because we got back down to 69.50. But anyway, so we had 4 now, now we're back to 2. Where are they? Active, okay. So now there's 2 short. But the 2 short have an average of 70.50 because we took 2 off the table. But at 69.50, we're up $1,000 a contract, so we take it off. So as you see, we have the $1,700 per contract gain is already baked into these guys. And at the moment, though, that's our basis. Our cost basis is 70.50 on the short, and we'd be stopping out though at 70. Should we pop up back there? In fact, frankly, right now we're at 69.63. So if we hit 70 again, we're out. That's the end of that trade. So we got 2 left though at the moment, and hopefully we fall below 69.50 and keep going down and make some more money on those. Right. So 2 more. So now we're back to 2. What was I gonna say? So yeah, based on that, the headline is what gets your initial move off the oil contracts, but the people who actually know what they're doing will read the gasoline and the distillates. And if you take 5 million barrels of gasoline and you refine them and turn them into gasoline and distillates, but nobody wants those, what did you do? It's just a magic trick of the refinery. You didn't use any oil. You turned it into something else that didn't sell. I got 5 million barrels of oil nobody wanted. I turned it into 5 million barrels of gasoline that nobody wanted. That's you don't get credit for that. That doesn't equal demand. Now, on the EIA report, what else happened? Let's see if we make this a little bigger. All right. So what else happened to the EIA? So we had a 7 million build of gasoline, a 4 million build in oh no, wait. They were 4 million last week. Where were we? Distillate fuel in. Oh no, add a 4.4 million barrel build. So 11.4 million barrel build and a 5 million barrel draw. So you're at 6 million basically total draw. I mean, sorry, total build. Although look at this sneaky crap. Oh shit. You want to see something even worse? All other oils. So things that don't get, so you turn oil into gasoline, distillates, and miscellaneous stuff. Miscellaneous stuff built by 10 million barrels. This is where they hide it when they have a big build. The miscellaneous stuff went up 10 million barrels, and it's actually a devastating 14 million barrel total build in oil supply. There you go. There's a reason we can expect it to fall much further. In fact, frankly, I'm sorry I stopped out of my 2. Imports have dropped off. Exports have dropped off a bit. They're back down to 2.5 million a day is a net exports. And of course, mostly petroleum products that we're exporting. So, we import the gasoline. We import the oil, turn it into product, and then we send most of what we import, we export back. That means technically America is energy independent now. If everyone's whoring about it, we've ended up being energy independent. We have 19 million barrels a day of production, okay, of product. 2.5 million of the 19 is, so let's go 16 million, 16.5 million. So of 16.5 million barrels a day that we are currently producing in America, for America, we get all that oil internally. We're only taking the imported oil is all getting basically made into something else and shipped out of the country. So we could cut that cycle off completely and only produce what we need internally, and we'd be completely energy independent. So that's kind of interesting. But again, that goes back to that goes back to then, where is the panic? Where is the shortage? How are we going to be affected by the Suez Canal having a backlog when we don't need that oil? So in other words, part of any commodity price is the potential for disruption in supply. In other words, the reason you're hedging your commodity futures is because you don't know what the future will hold, and therefore you want to assure you're getting a certain price long term for a commodity that you need to purchase. So if I buy oil futures for 2026 at $60 a barrel, it's because I want to make sure I'm still paying $60 a barrel in 2026, because I don't know what's going to happen. Something good may happen, something bad may happen. I just don't want to take any chances. That's what futures trading is really supposed to be for. We use it as a casino, but in reality, it's supposed to be a mechanism to prepay for commodities generally. So if you've got the I'm sorry, we're trying to figure out how to best explain this. So there's a factors included in your forward pricing is going to be the possibility of supplies getting smaller and they get more expensive, the possibility of inflation, the possibility of some kind of supply disruption. Now, there's a couple of things in the supply disruption. Let's say that's worth $2 a barrel, $3 a barrel, who knows what it's worth, probably worth more. But if you say that there's a couple, let's say 5% of the price of oil is based on the potential for supply disruption to cause it to go higher, well, how's that going to happen? We supply all of our own oil. We're not subject to to the whims of foreign production. Meanwhile, the foreign producers, the OPEC, just had a meeting, and in that meeting, it was determined that they have something in the neighborhood of 6 to 7 million barrels of spare capacity that they're not using. So even if there's a war, and even if you knock out one of the major oil producers, they're still not going to hurt the capacity. Even if you bomb Iran, even if you ban Iran exports, I bet Iran exports are already banned. If you start letting them export, that's going to add more to the glut. So that's when you look at oil and say, oh, this is shortable. Look, they're not taking any of this crap into account. That's why we got excited about shorting it again all of a sudden. We weren't excited about shorting it until now. Now it's getting much more excited. These trends were there, but now they're getting sort of like undeniable. It really started around that last OPEC meeting. Two things happened. The price of oil shot up into the OPEC meeting, and the OPEC meeting unveiled certain facts that we started looking at the oil picture and saying, no. There's no way that there's a shortage. There's no way they can engineer a shortage. There's no way there's going to be a massive spike in demand. Everybody is predicting this incredible surge of demand. It's not showing up anywhere. That's what this report clearly indicates. The demand is not coming back, and I have said this for years because very, very simply, the let's see if we can find this. CAFE standards is what they call it. CAFE standards, and let's see where we are. Images. So the CAFE standards are the miles per gallon that the fleet of cars in the US is supposed to get. And I'm trying to find one that's recent. I guess you have tools and you say time, past year. There we go. That looks good. Except I don't know if that takes into account how did Trump mess with this thing? That's what I'm trying to figure out. Trump screwed around with it somehow, but I guess it's going to get back on track because it's pretty easy to fix. But let's just keep it simple and look at where we are. Because even if Trump messed it up, Biden's going to put it back on track. And our standards are terrible compared to the rest of the world. But here's where we are. If you have a car that's older than 2010, basically, okay, you're on the old system. Your car got about 25 miles per gallon. Okay, that's the average car in the fleet. The goal of the CAFE standards is to raise the fleet average by 2021 to 40 miles per gallon. So cars now should be getting 35 to 40 miles a gallon. Now, if you have a car that was getting 25 miles a gallon and you drive the normal 15,000 miles a year, right, divided by 25 miles a gallon, you need 600 gallons of gas per car. Now, if you're driving the same 15,000 miles and you're getting 35 miles a gallon, now you only need 428 gallons. So 428 divided by 600 is 71%. So you're using 30% less gas. Now, the fleet of cars that we have on the road now compared to the fleet of cars we had on the road in 2010 is 30% more efficient. That means on the whole, we're going to be using 30% less oil. Oil consumption for cars is automobile transport is roughly 1/3 of all oil consumption in the country. So if we're using 30% less than 1/3, that means we're using 10% less oil in our vehicles. But that's automotive miles, and trucks are becoming more efficient. And other things that we do with fuel are becoming more efficient. And the plan is to go up to 55 miles a gallon in the next 5 years, basically. And that's going to take it. That's how you electrify the fleet. The more every electric car is zero, so it takes the average down significantly. And then if you have 1,500 miles, 15,000 miles divided by 55 miles per gallon, you're only using 272 gallons. So now we're using half of the oil that we used in 2010. And obviously, almost every single car from 2010 is going to be off the road by then. In fact, the older cars will be the 2020s that get 30 miles a gallon. So in 2030, we're going to have the low-end cars are going to get 30 miles a gallon. High-end cars will get 50+ miles per gallon. And we'll be using just, very significantly less fuel than we used in the past. Then you start electrifying all the public transportation and so on and so forth, and we drop it even lower. So those are good things. It doesn't solve everything at once, but there's other things that are in the works to solve these problems as well. But the key is, though, given that, and we're not there yet, we're talking about a 50% reduction over the next 20 years in our fuel consumption. I'm sorry, in our auto fuel consumption, which works out to a 15% total reduction in usage. So every year, we're going to be using basically 1% less fuel than we used the year before, every year. Now, that's going to just keep grinding down and grinding down, and we aren't adding enough new passenger cars. We aren't driving enough new miles to make up for that. It's not a growth industry. The miles driven is not a growth industry. The number of cars is not a growth industry. Some increase in population, but not significant enough to offset these savings. And that means every year we're using 1% less is a lot when you're using every week we're using what, 7 times 16, right? So 16 million barrels, 7 times 16 is 112. So every week, every year, every week, we're using 1 million less barrels. That's what this works out to. And how do we measure our EIA report in barrels per week, right? That's what we're looking at. So the pressure on the EIA report between 2019 and now is 2 million less barrels of oil are being used per week than we used back then. And specifically, obviously, gasoline. 2 million barrels of gasoline less are being used now than then. Next year, 3 million less. The year after that, 4 million less. Every week, the pressure is going to be on a build and a build and a build. And if they don't cut back production, if they don't look realistically at this, and they keep trying to pretend, as you know OPEC does, they keep trying to pretend demand is coming back. They always say it, demand is coming back, demand is coming back. Now, it's confusing with the the pandemic, everybody's like, well, sure, that makes sense. Yeah. But the reality is demand is not coming back to the levels where it was before. But they still want to produce what they produced before. People just don't want it. This is this is what happens to like a chain that goes, like a fast food chain that goes out of business, right? They're faddish for a while, like these chicken things, right? Like for a little while, everybody wanted these chicken sandwiches. I don't know why. I can't imagine how bored people must be in their lives. But people were lining up around the block to get a chicken sandwich. Now you walk in, you get a chicken sandwich. It's like at every single place they have chicken sandwiches. You know, they still want, especially the people who are the leaders of this thing, which were like Popeyes, I guess, and whoever. The people who led the chicken sandwiches, they still want it to be a thing, and they're advertising it like crazy, and they're putting specials out and so on and so forth. But the bottom line is the fad is over. And oil doesn't seem like a fad, but it is. It's a fad fuel. Oil wasn't a thing 100 years ago. Coal was a thing 100 years ago. Before coal, there was wood. You know, we clear cut forests to make wood for fire, so we could power all sorts of things with wood. And after wood, we had coal. We strip mine the crap out of the whole planet to get coal. Then all of a sudden, everybody jumped into oil, and now oil's the thing. And now what are we doing? Now it's all about lithium and batteries and so on and so forth. That's our next fad. Our fad is whatever is the newest, best energy source. Oil is fading, and it's going to fade, and eventually it'll be zero. And if I had this conversation with you, if you were a coal baron, look, people didn't give up on coal until just now. Oil has been dominating for 100 years, basically, has been going up and up and up and up, and coal was going down and down and down. But literally, when we started PhilStockWorld back in 2006, we were talking a lot about BTU. BTU was a big coal company back then, and they were great. And we argued back and forth, was it a good investment? I thought it was a good investment. I said they were killing them off too early, and they had another nice run up. But after that, that was the end of it. There's Arch Coal, BTU, things like that. We used to talk about coal companies. We don't talk about coal companies at all anymore. They died. And oil companies, and that's what we were writing about this morning, which I started writing about this morning, but it got more into like climate change. But oil is on its way out, and here's the nail in the coffin is this. Royal Dutch Shell is being ordered by the Dutch court, that's their country, it is being ordered by the Dutch court to cut emissions by 45% by 2030, which is only 8.5 years from now. They got to cut out like half the emissions they have by 45% by 2030. Now, of course, they are appealing this, but the appeal is going to take 2 years. Now, if you're Shell and you're appealing this and you have to cut by 5% a year, you can't not cut. You can't just say, I'm not going to cut and I'm going to appeal this law, because if the appeal goes against you in what the hell year is this? In 2023, if the appeal goes against you, now you've done nothing and you still have to cut by that much, and you'll never make it, and they're going to fine the crap out of you. There's too much risk. So what they have to do is they have to start cutting their 5% a year right now while they're appealing. They have to hope that when they win the appeal, if they win the appeal, they can stop cutting, but they won't, because they're not paying. See, they're not smart. Total is smart. That's why we invested in Total. Total is an energy company. They're in Europe. They have already been doing this without being asked. They said, we are going to turn ourselves into a green energy company because green energy is the future and oil is dead. And oil is dead enough now that they are being sued for being oil companies. Just like when you were a cigarette company, you got sued out. People sued them out of existence or knocked them down anyway. These energy companies are going to have the same problem. You can't just decide that you don't care about polluting the planet, because the planet has people in it. And there are non-oil producing countries and Holland happens to be one of them. Obviously, they are the home to Royal Dutch Shell, but Royal Dutch Shell doesn't have any rigs in Holland. Nobody's like pulling oil out of the ground in the Netherlands. So there are other countries who don't benefit from the oil companies, don't get oil money cash, don't get to have political parties that are backed by oil companies, and those countries are going to sue for effectively secondhand smoke. And they have a right to, and there's precedents all over the world for this sort of thing. And what's in Holland? In fact, what court did they go to? They went to The Hague. And so this sets a very major international precedence, and it's going to be governed by international law. And you're going to have, at least some of the time, you're going to have Americans, when the Democrats are in office, that are going to be backing this in the UN and everywhere else. And the trick is, and they're not stupid, they're all going to realize this, the EU and America, when it's democratic, are going to jump together and bandwagon together and start passing some serious laws. And they're going to outvote Russia and China. They're going to get a whole bunch of other countries going to outvote Russia and China, and we're going to get some major international policies changed. John Kerry thing, really listen to John Kerry. I put him at the end of the thing here. He was sitting there at Yale talking about some basically an overview of what his thinking is on all this stuff. And look, I don't want to get into this because I don't feel like it. It's just depressing. But we are so screwed. Okay, this line 400, right? 400 parts per million of carbon CO2 in the air. This was the very big danger zone that we should not have crossed. We crossed that, and we have just kept going without even a pause in how much carbon we've been throwing into the atmosphere. Everything they talked about, everything they said was urgent with the Paris Climate Accords, and everything they said they were trying to avoid, we've done nothing at all to avoid it. And what's happening now is the Arctic sea ice and the Antarctic ice shelf are already melting and falling into the ocean. They don't know. They don't know. They do know. There's no way to stop it. We have totally screwed it up. And not that we could have really stopped it. That particular thing we really couldn't have stopped. It's too late. But that then causes a cascading failure because these ice shelves, the water in the middle of the Arctic, it recedes and falls, it melts, it freezes, it melts, it freezes, it comes back and forth. It hits these ice walls that are close to the ocean, and they hold them back. These giant ice shelves that have been there since the Ice Age, they hold back all this water. And you don't think of ice as flowing, but ice does sort of flow. It has a flow to it. They prevent it from falling into the ocean and mixing with the ocean. These shelves are now collapsing. And once they collapse, there's nothing stopping the looser ice that comes from the inland from just turning from an ice flow like a moving ice flow, turns it from an ice flow into a river that starts just being, you'll see waterfalls coming off of in the Arctic and melting away into the sea. And then the sea is being fed this stuff that used to be trapped in land or trapped above the water, not always on land, because there is no real land in the Arctic. But there is Greenland, of course, which is covered in ice, Greenland ice sheet. And this is terrible. This is beyond terrible. That then causes all sorts of horrible things to happen. But that's not even the near term. Then short term, the permafrost is melting in Russia and Canada, and the permafrost, by its nature, has been trapping greenhouse gases for 100,000, 200,000 years. So what's going to happen then as the permafrost melts, and in Russia you can actually see, they've got film of it, it explodes. You see methane exploding out of the ground. So these things that have the pressure and the CO2 that's been trapped under the ground for thousands of years, as the ice finally melts, it blows a hole finally through the ice and escapes into the atmosphere. And it's like that. this one explosion is like worse than a million cars burning gas at a time. And this just keeps happening over and over and over again now. And again, now that's a bad cycle. That then warms the atmosphere more, it causes more Arctic ice melting, causes more permafrost to melt, boom. So we're being screwed at an accelerating rate, and they're all of a sudden just thinking this is like much worse than they thought anyway. You know, the reefs are disappearing in South Africa, and the rain's bad. We have a massive drought right now in the U.S. that we knew about. We just had record-breaking temperatures in the U.S., record-breaking temperatures in the Middle East. Oh, here, in the Middle East. Record-breaking temperatures in the Middle East. I mean, look, these people aren't idiots. This isn't like a made-up chart. This isn't like that thing Trump drew with a marker. This is like real stuff that's really happening, and it's really depressing. So again, like I said, I didn't want to get too into it, but it's not good. And we had 20 years to fix it when we did the Paris Climate Accord in what, 2014? When was the Paris Climate Accord? Paris Climate Agreement. When did we do that? Come on. Wiki. Paris Agreement. Oh, come on, people with the frickin' things. Only Wikipedia is useful. It actually says what happened when. (2015). There you go. All right. So so here you go. From 2015, it was signed in 2016, and as of March 2021, 6 member states have not ratified it: Iraq, Iran, Turkey. The U.S. withdrew from the agreement in 2020 under Trump, but we rejoined as Biden became president. So we only just now rejoined and got this thing back on track. And we've done nothing though. I mean, 5 years, literally nothing has been happening, and we only had 20 years to avert a complete catastrophe, and we've wasted 1/4 of that time already. So believe me, and again, that's what John Kerry's talking about, is like, we don't have time for this. We do not have time to debate it. We don't have time to argue it or whatever. It's literally like having a debate with somebody who's like, the house is on fire and they want to sit down in the living room and debate whether or not it's really on fire or not, you know, while the thing's burning and embers are landing on you and so on and so forth. This is way past that point. Anyway, so that's going to affect a lot of stuff, including what we invest in and what we look at, and it's not long term. And you got to get that out of your head. This is not a long-term thing. This is now. This is right now. You're going to start seeing oil companies. This is like me telling you in the, early in the cycle when cigarettes got linked to cancer and the science was undeniable and whatever, and the whole world started paying attention to it, and everybody was like, oh well, they cigarette companies, they'll be fine. You know, they are fine in the end because it's such a profitable product. And now, but now that, now they're only selling to the people who it says on the pack, this will kill you. And people are like, okay, good, let's get one of those. So that's your oil, your consumer of cigarettes now is somebody who reads the warning label saying this will make you dead. And they go, okay, yeah, give me 3. This is not the same thing. This is they're going to legislate oil out of existence. We're early in the cycle, so you can look at it and say, okay, well, maybe there's still some money to be made there, whatever. We still need oil. So you'll find me at cross purposes sometimes, because we do still need oil. In fact, we invested in OIH. We just put money into Baker Hughes, I think it was. No, not Baker Hughes, I'm not kidding. Halliburton. We just picked Halliburton as a trade. Because there's been an underinvestment in oil, and also though because Halliburton, they're really a building company more so. They're associated with oil because that's where they specialize, but they can just as easily specialize in building solar installations, massive solar installations and things like that. They're a logistical building company. So, you know, they're, and I think the association with oil has been keeping them down, but we find them very interesting as a trade. And we got them, I forgot when we got them, but were they a top trade? Did we make a top trade out of Halliburton? Oh, now it doesn't recognize me. What? Oh, it's not admin, it's Phil. Please wait 2 minutes before log. You bastard. No, not admin. Phil. Oh, this is freaking annoying. I cannot get into PhilStockWorld. 2 minutes. Anyway, where are we? What is this? That's an image from PhilStockWorld. Here's PhilStockWorld. Let's see how that goes. Nope, didn't like it there either. You think? Still. I think it keeps resetting every time I try. Oh well. All right, let's see if anyone has any questions. Nope. Tom says oil is popping to throw off the shorts. Did it pop? Not popping, it's bouncing. If it falls $1, then it's supposed to bounce 20% of the drop. So that would be 69.70 is a weak bounce. 69.90 would be a strong bounce. That's what you expect after a $1 drop on oil. That's very significant for one day. So the weak bounce, I'm certainly not going to get out of my. I did, you know, we did take 2 off the table at 69.50 because that's $1,000. You don't not take $1,000 per contract off the table, but you know that you're going to get a bounce. In fact, you know, you could easily argue that when you do hit 69.50, you should take them all off the table and then re-enter at the weak bounce point because you're almost certainly going to get to the weak bounce. So why ride it out for free? That's always something to consider. Now in my case, the answer is because I'm in the middle of giving a webinar and I don't have time for this shit. But if you do have time to sit there and stare at it, then yeah, why let it go? All right, has that been 2 minutes, do you think? Yay! Now, what the hell are we doing? So we were talking about that. Oh, I know. I was going to look at Halliburton to see if it was a top trade. I don't know if it was. Nope. Just a notion that I had. I forgot when I had it, so I'm not even going to bother looking. Oh, today we did AIV. So AIV was Aimco. All right, and they split into Air and into Aimco, and so still Aimco, still AIV, but this is actually a tiny part of the problem of the business, and so the actual apartments went off with Air, and they're just a normal REIT moving along. The development and redevelopment of apartments, in other words, their specialty of taking somebody's building. In other words, you the investor buy a building, and Aimco comes in and says, "Hey, we're like super duper experts at refurbishing, remodeling, and renting and managing apartments because we had all this experience when we had these." They still have those. They still manage these, so they have a management contract already locked up here, and now they're going out and getting new management contracts with other properties. All right, so that's, you know, it's fantastic. I mean, it's you know, it's something I would do if I was running the business. So I liked it a lot. I was looking at them. They were very under priced. In fact, they're down to their market cap is 1.1 billion. They've got 1.3 billion in assets, and they haven't even really started their business yet. They only recently did this. they are going to easily grow and double up in the fairly near future by just adding some contracts, managing more properties. And can they do that? Sure, as long as they don't do anything stupid. And again, they're not stupid people. They're going to keep it geographically stable so that their key management people, their top brass, will be able to go from one building to another building to another building, making sure things are running right. Then you develop new teams that are able to, they help develop the new teams that run the buildings. Then you find better people. Then you have another person who can manage, just build it up like that logically. I like these guys a lot, though. It's a nice small little thing. And the way we're investing in it is kind of aggressive. What we're doing is we're selling. They're at 761, and we are selling the 750 puts. But all that's really saying is that we don't mind paying 750 for 500 for 2,000 shares. So we'll pay $15,000 for the stock right here. That's what we're saying when we sell these 750 puts. That we say, okay, yeah, we'll put 15,000 into it. Not a huge commitment, and we're happy to do that. So when we sell the puts, we're making an aggressive sale of the puts. We're buying 2,000 shares already for the same $15,000 basically. So we're basically saying now we're going to commit $30,000 to buying the stock at about 750. We're selling these 750 calls for $1.10, which knocks 50 cents off the price here. So our net cost is going to be, if we have 2,000 shares, we would end up with a net cost of $650 on the average. So it'd be, we'd have 4,000 shares at $650, which is $22,000. So that's where our commitment is. It's only 22,000 shares. Oh, I'm sorry, at an average of, I'm sorry, that would be 550. So it's not 650, it's 550. We're at 650 here. Wait, we're average 650. Oh no, I'm sorry. That's what it is. If we're assigned 2,000 more, we average 650. But then if we had 4,000 at 650, what would we do? We'd sell 40 of the calls for $1, whichever calls it is. We'd sell 40 of the calls for $1, and then we'd be dropped to 550. So our worst case that the expected worst case, it could suddenly go to $2 and this wouldn't work. But assuming they don't collapse completely, we don't think we're going to pay more than about $550 average for 4,000 shares. So our commitment is $22,000. But as it stands, we're only paying $11,200 for 2,000 shares net. And if we get called away at 750, that's $15,000. So we're going to make about $4,000. And that, by the way, is between now and December. This isn't even a long-term thing. That also means less things are likely to happen between now and December. So where's that chart, AIV? And the thing is, again, they split out of, that's why it only goes back this far. They split out of the original AIV. They undervalued this portion of the company. It was like a throwaway, or it seems like a throwaway, but it's not. And it was grossly undervalued here at probably $800 million or 700 something million dollars. Now it's at $1.1 million, still undervalued. And we're playing it, we're not playing it super aggressively. We're playing it a little bit aggressively because we think that the price range is certainly in this area. And if it just hangs on to this price range, it'll be great. And eventually we'll be able to collect a good amount of money. And we expect them to pay a dividend also, because they're REIT people. They'll probably pay a dividend down the road. So we don't mind accumulating a bunch of shares. And then if they start paying a dividend, that'll be how we get paid out in the future. And that's why it's in our dividend portfolio, even though they don't actually pay a dividend. So, look, when you're forecasting and predicting what's going to happen with the stock, not only are we predicting, wow, is this still? No, that was from 6.2. I was going to say, how could it still be the same price? That would make no sense. So not only are we predicting the value of a stock, but we're actually predicting the future, what the company's policies are going to be and how they're going to shift. So I predict that this company will become a dividend-paying stock in the future. And like I said, our short-term portfolio is still 18.5%. That's amazing that we're still positive. You know, it's because these are all hedges. These are all things that only pay off when the market goes bad. So we are doing fantastically from that perspective. Our CMGs are holding on. That's helping a lot as a trade. And then we've got the Wegmans. How's Wegmans doing? No, Wegmans is not really, we thought they'd be lower. So this is not really performing as we wish it would. So it's really CMG that's doing us a big favor right now. FXP is on track. And of course, but then we have SQQ, two sets of SQQs and the TZAs and the TQQs. FXPs are China shorts. XRT is expiring. We forgot about those. That's dead. And SCO isn't working out either. So I mean, it's not bad considering how many things are not working out. So holding on to 20% is fine with us because these are the hedges. They're not even supposed to be making money in a bullish market. And we'll see what happens, but there's no need to do much with these. And as I pointed out, our long-term portfolio, so it was 287, now it's 288, so it's up a tiny bit from last month. So on the whole, the long-term portfolio, since it was 287, is now 288, and we know that the short-term portfolio is down 20%. This is a losing month for us so far. But we don't care. We're super bullish on all these positions. We've got tons of money rolling in, and you can't win every month. We won ridiculous amounts of money last month and the month before. So we're just waiting to see what happens this month, and we'll make our adjustments accordingly. But so far, you know, we keep expecting the market to fall back down, and it doesn't. Just keeps going and going and going. All right, so there's that one. Did we do any others before since the last webinar? June 1st. No, June 1st was before last week. So we're all caught up looking at the top trades anyway. And how's oil doing? So oil's still bouncing. The rest of the indexes are not looking very exciting. Not a whole lot going on though. It's like super. I think people. I get the vibe that people just don't have a huge interest. I was surprised a lot of people signed up. We have a webinar tomorrow, by the way, with TD Bank. I put the note out in the chat room today. In fact, I don't have it. Hopefully you guys got it. I put the note out in the chat room. Tomorrow at 1 o'clock, I'm doing a TD Bank webinar. It's just basic stuff, though. It's just, you know, how to sell, selling options to make money, things we talk about all the time. But I'm surprised that like 1,000-something people already signed up. So that's a pretty good amount. I mean, I remember we did one of these things with Nigerian, and he's got a big audience, and only 500-something people signed up for that. And he thought that was a good number. So I think 1,000 people signing up for a thing is probably pretty good for a webinar. And that's obviously only the people who view it live, and then it goes around. So, but on the whole, though, things have been pretty slow and pretty boring, and there hasn't been a lot going on, not a lot of news, not a lot of stuff. I think people are just like so determined to enjoy their summer right now. I think there's a lot of that because, you know, nobody had fun last summer. Nobody, you know, it's been a while since we've gotten out of the house and done things. Apple Podcast subscriptions rolling out next week. Apple announced podcast. Oh, see, we should do this. Which has been pushed back to new podcasts have the option to offer subscriptions such as ad-free early access in late April. Spotify. See, I don't even know how to do that. This is what we need help with because I don't know how to do any of this stuff. Because sure as hell got enough content we could be selling. So Facebook has smartwatches, best stock, SEC. I mean, there's literally nothing happening. Electric battery, Twilio, Chalco, Conta, Roche. What did Roche do? Oh, Alzheimer's candidate. Everybody's got Alzheimer's things now. Funny how these things go in cycles, right? Like all of a sudden it's Alzheimer's time. Get a little loving. Checkpoint. Wow. Sees 67% upside potential. Holy crap. The hell do they do? The lead compound, the antibody Carnival, has been comparable and approved to therapies in the same class. Oh, who knows? Let's see. Pfizer. Well, we know Pfizer's underappreciated. How's Pfizer doing? See, I can get behind a Pfizer call because, oh, what the frick? Oh, what did I just do? Just screwed this thing up. That's the wrong chart. You know, I can get behind the Pfizer call because the whole company's good and anything like that is a bonus. So when I see that, but when you see it on a small company, an item like this on the other one, then I'm like, it's only, you know, you have to know something about it. You can't just assume that this guy knows what he's talking about. So what was this one? CKPT. But you know, that's, let's see. But it's interesting and it's worth checking out because this guy's saying this is a $10 company at least. So it's still got miles of room to run. But the question is he right? Does he have any idea what he's talking about? Or is this just bullshit? You don't know who this guy is. You don't know if it's just some PR. You know, it's all got to be looked at. Renewable energy is a buy. Look at that. I mean, see, this is the problem. Look at this news. This news sucks. There's nothing interesting going on in the news, and this is going back hours already. Is Fisker getting some love? I don't think they're that much different than Tesla. I wouldn't go for it. How's Tesla been doing? They were trending lower. Yep, still 600. So not trending low, they're still sitting around 600. But they are, I think, consolidating for a breakdown. I mean, I don't know how he's going to pull a rabbit out of his hat on this one. He seems to do it though. Oh, that's the airs. May block surge 134%. What? Increased blinded recovery, unused block hours. Total block hours, block American. Most increased before this is traffic usage. That's a big increase, but you know, when they talk about it, they're talking about versus last year, and last year was kind of dead. Total departures rose 99.4%. Wow. You know, but still, nobody traveled last year, 194%. And they don't give you the context. That's what pisses me off with these things. It's because it sounds impressive, but versus what? You know, what was 1990? I don't care what 2020 was. What was 2019 like? See, look at this. It doesn't even mention it. So last year, I don't know who was on these flights. Last year, there were 5,000 blocked hours of flights, and on American, now there's 11,000. The year-to-date total, see, what does that mean? How can we be minus 20% for the year? See, that doesn't sound right. If we're down 20%, and look, consistently 25%, total completion factor statistics. So if we're down 25% from last year, January, February, March were normal months, more or less. March, we started falling apart. But January, February, March, basically last year, we had good months. So basically what this means is even though this May is much better than last May, the reality is that this half is running 20% behind last year's half. So that's kind of interesting, isn't it? So in other words, we had a normal first quarter last year, then we dropped off considerably, but I guess the drop off probably, you know, in March, you kind of, if you had a flight booked, you probably got on it in March until they really nailed the lockdown restrictions at the end of March. But if you had a flight booked, you weren't going to probably cancel it with the airline. I mean, hell, people weren't canceling cruises. So they had a normal first quarter last year. Then this obviously would only be through May. So then April and May, they dropped off. But that drop off didn't impact them as much as having a slow start to this year. And only now in May are we starting to come back to like some good numbers. So you see, that's what I mean about reading a report, though, because if you think about it, the impression you get from this report is that things are great. But when you actually look at the report and go, it's not great, we're still 20% below last year. Below last year. Last year sucked. Last year, airlines lost billions of dollars. And yet the people who are investing in these things, you know, for like, you know, they were talking about United and American, UAL. United back at 57.50. Is American still a thing? Yeah. Like, do they even exist anymore? So these airlines are back to where they were. And let's see if UAL. We talked about this last week. So 5 years. So they were at 89. Okay, right now they're $18.6 billion. They're at 60, basically 60. They could be as high as 90. So they're 2/3 recovered from where they were before all this happened. Okay, should they be, is the question. I don't see why, because realistically, what are you really paying for here? In 2019, look, nobody was bothering them here, and they made $2 billion, $2 billion, $2 billion. 2019, they made $3 billion. They had a good year in 2019. 2020, they lost $7 billion. This year, they're going to lose another $4 billion. That's $11 billion of either less cash or debt going forward than they had in 2019 when you valued them. And how much are they being valued at now? They're being valued at 18 now. They were being valued at 30 billion here. What happened? This happened, $11 billion. This is real. This isn't a mistake. This is real. And the thing is, this $11 billion has to be paid back. So let's say they pay it back over 10 years. That's $1 billion a year coming out of their earnings. So if they're paying $1 billion a year back, you know, again, whether they're reborrowing the money or whether they're putting it back in the cash to get back to where they were in 2019, it's going to be 11 years. They're going to basically, this 877 is because they've got $1 billion annual deficit they've got to refund and push it back in there. That's why their bankruptcy risk is still, that's why their bankruptcy risk down here is still very high. Because I'll tell you, they did not have 11 billion in cash to toss around. You know, so these airlines are in trouble still. They are going to have to somehow, you know, raise fares and do whatever. I mean, they can't, you know, and the thing is, don't forget, they already were making a huge amount of money because they were charging for all sorts of bullshit like baggage fees and so on and so forth, and people were getting pissed, and they had already crushed the seats. Remember what we were complaining about like 2 years ago? We were complaining about the baggage fees were out of control, and they are so out of control. So completely, $35 now. I just booked my daughter to come down here. My daughter just came down from New Jersey to see me, and the plane flight was, I'll say $300. I don't actually remember the number, but let's say the plane, it wasn't a bad number. It was like, so let's say $300. There probably was. So the plane itself, $300, but the baggage fees each way, $35 per bag. That's crazy. $70 more for the bags. This is where these guys have been making their money. You know, and my daughter bought a sandwich at the airport because she said, you know, because she's in college now and has to pay her own stuff sometimes, and she's starting to worry about things. And she's like, I'm not paying for this food on the airplane. It's insane. Like, they charge a fortune for the stuff on the airplane. So she's in the airport picking up a sandwich for the flight. And that's the first time she's ever done that. She used to get whatever, you know, she used to love buying things off the cart. That's when I was paying for it. That's why. So, you know, they were getting away with a lot of stuff. Oh, and the crushing people's seats. Remember, like, there's this whole thing about, like, is it torture at this point, the way they've got the seats arranged to, like, shove every last possible person in? They are in trouble. And this is not necessarily a working model. Airlines go through cycles. They have up cycles and down cycles, and we had an up cycle. Then people think this is going to keep going. But you're not going to zip back to this up cycle, because now they've taken on unbelievable amounts of debt. They unexpectedly lost $11 billion. They didn't have $11 billion sitting around to lose. If Apple loses $11 billion, it means nothing to them. But this is not Apple. This is a company that's only worth $24 billion in the first place, lost $11 billion. And it takes them 3 full years at max, not four full years basically, at maximum profit to make $11 billion. So the entire next decade, half their profits are down the drain already. How does that become a good investment? And it's the same thing with ships. Oh, where'd that go? So here's Carnival Cruise Line. Also, they were, you know, let's call it 50, 60 bucks. So they were at 60 bucks. Now they're at 30 bucks. So they're 50% off. But why are they 50% off? Because they lost $10 billion last year. They're going to lose $6 billion this year. They ain't going to make shit next year. So they lost $15 billion that they didn't have. And this company is a 35. They were a $70 billion company. That's crazy. I don't know whoever called them a $70 billion company in the first place. That's really painful for them. And again, see the bankruptcy risk? You got to be really careful about assuming these companies, just because you hear good stuff doesn't mean they're going to come back. How about Marriott? So Marriott is back in full. Should they be? Ooh, look at what happened to Marriott. Nothing. Marriott lost $200 million last year. They could, obviously, Marriott being a $47 billion company, they lost $200 million. They could laugh that off. They were making $1.5 billion a year. They're frankly, a little pricey at these levels anyway. But the fact I wouldn't necessarily buy them here, but there's nothing bad about them, because going forward they're fine. They're going to have a not particularly great year this year, but you're buying them to say, okay, I've got this company. They should grow back. They should be able to hit in this. They should be able to get back to this $2 billion zone going forward. And if they're at $2 billion, it's only 23, 24 times earnings. Not terrible, not great, but not terrible. But it's an okay thing. That's a big difference, though. This is the thing. That is a big, big difference. Just one little loss, and now we're back on track, and we're going to make it up, no problem. And obviously, they didn't go crushing into debt for anything. Might have slowed them down, might have caused some other stuff, but they're fine. And you can see that here too, not the bankruptcy risk. You got to be careful investing in things, and don't make assumptions. I hear too much of that from people who say, oh, this is coming back and this is going to be strong. It's like, no. And there's a lot of industries like that. There's a lot of people who are affected, who are going to be long-term affected. You don't just turn around and come back and just declare everything's fine. These losses are a noose around the necks of these companies, and a lot of them are carrying them forward. They're not getting bailed out. That, by the way, is also part of the assumption. The assumption on the airlines is they'll get somehow bailed out of this debt, but they won't. Nobody's going to pay off all this debt for them. Nobody's going to just hand them billions of dollars. It's a political nightmare to do something like that. And as long as they're not going to go bankrupt, it's fine. You know, frankly, they would have been better off. They should have pressed harder to get something while everything was going on, because, and they did get, and they did, by the way, get billions of dollars. They got tons of aid, but they still are teetering. All these companies are teetering. The cruise companies, and the cruise companies, the reason the cruise companies suffered, they're not American companies. Nobody bail them out. All these genius cruise companies who domicile themselves in, like, you know, in the Bahamas or something like that. The Bahamas isn't going to hand them out billions of dollars in aid. That's one of the reasons you want to be in American companies. If anything really bad happens, America's there. If there's cyber attacks, right? America will protect you from cyber attacks. America will crack down and make sure you're, you know, the FBI and the full force of the government will be on top of it if something happens to you. If you're a Bahamas company and you get ransomware attacks on your system, you're out of luck, because the Bahamas are not going to help you. You know, they would if they could, but they can't. They're still the Bahamas. Oh, they're so corrupt. So yeah, they're more likely to be the ransomware attackers than to help you from the ransomware. Anywho, so, you know, you got to look carefully at these investments. I know a lot of stuff looks tempting because it's historically low, but in the end, you look at it and go, ooh, you know what? That's probably not the smartest thing to be doing. So keep that in mind when you're looking at companies and valuing. And as I was saying, in fact, I was talking to the members today, and we were going through trades, and that's how I came up with you guys, you don't realize it, because I'm spending a lot of my time now like looking for things to buy, and I'm looking at hundreds of things, and then once a week or so, I'm like, oh, here's something. It's not easy in this market for me to like find something I actually believe in. NRG we picked a while ago. As I said, we got AIV. I mean, I wasn't looking for AIV. I just you know, they're just a small apartment REIT that I didn't pay any attention to generally. They split up though, and I was actually kind of interested in what they were doing here. But then as I was reading about somebody else, their name popped up and I reminded me to like read and see what they're doing. And then I looked at it, and I wish I'd seen it sooner, because they were totally undervalued a while ago. But the bottom line is there's no question that this is like a little gem. You know, it's really interesting that they would let this happen. So we have that one. Oh, and Cowen, that one I'm really happy about too. Again, I wasn't looking for Cowen. I was looking at Goldman Sachs. I was looking at JP Morgan and stuff, and trying to think like, who's in the best shape? Who do we want to invest in? Who do we feel good about? And then I'm looking at Cowen and going, whoa, wait a second, because like, look, here's Goldman Sachs. All right, and Goldman Sachs is higher than high, higher than they've ever been. $130 billion market cap. They're pulling in 15 billion in earnings. So the P is 10. It's a great company. Nothing wrong with that, right? They've got, you know, they're in great shape. They're making tons of money. I don't believe, this is the thing, I don't believe that you can really extrapolate. These numbers are difficult to say they're going to keep making this kind of money. They made, they're projecting a very unusually large profit this year, and then it trails back down. But still, nothing wrong with making $11-12 billion on a $130 billion valuation. So I'm not saying they deserve to be lower than they are now. In fact, I think we have Goldman Sachs in one of our portfolios. But I just, I don't think it's not something I want to chase. And then you look at JP Morgan. And I usually like JP Morgan better than Goldman Sachs. They're at $500 billion now. One of the things I like about JP Morgan is they have an actual bank. They have Chase. So I kind of like the fact that they have that to fall. Like if everything else goes bad, they still have a bank to fall back on. They're not as good on paper, 499 billion. They only make 39 billion. So their PE is like 12.5, 13. So basically their PE is higher than Goldman Sachs. Oh, 13.1 it says. So their PE is higher than Goldman Sachs. And but like I said, though, I always like about JP Morgan, they got the good steady banking business. You see 108, 115, 119, 121, 122, 32, 36, 39, 34. They're not expecting unrealistic amounts of money. There's no special thing. Goldman is expecting a massive, massive gain. Whether they get it or not, we'll see, but probably they will. I mean, don't ever bet against Goldman Sachs. But as I was reading some crap about these guys, Cowen's name popped up, and I never really, we all hear Cowen Company, blah, blah, blah. You all hear of them. But when I took a look at the numbers, I was like, holy crap. I'm like, these guys you can buy for $1 billion. They've got, I mean, again, nothing comparatively to the big boys, but they've got $2 billion coming in revenue, basically. They've got, they're making a couple of $100 million. If you look at the next couple of years, they're making a couple of $100 million. They're in good shape. They picked up a lot of business in the last 2 years. They're not expecting it to continue. They're not expecting it to keep going at that pace, but they're still going to make a nice $200 million against a $1 billion valuation. That's a PE of 5. And that's putting them in a good spot. And they can not easily, but they can easily grow to a much larger number because their competitors are massive. We look back, I mean, JP Morgan, $122 billion, and Goldman, $50 billion. So figure JP Morgan's investment banking is probably the same 50 billion. So you got JP Morgan and Goldman Sachs doing $50 billion a year in investment banking. Cowen's doing 2. All right, so can Cowen get to 3? Yeah, Cowen can grow 50%, a hell of a lot easier than Goldman Sachs or JP Morgan, because for Cowen to grow 50%, they only have to take 1% of the business away from Goldman Sachs and JP Morgan. So it's a lot easier. But for JP Morgan and Goldman Sachs to grow 50%, they have to add an entire Goldman Sachs or JP Morgan to what they're doing. So I like Cowen. And again, you have to kind of say, well, they're all kind of the same. All these little investment banks are basically not that different from each other. And once you have a good name, reputation, and people are coming in and giving you money, as that spreads, they can become a good alternative for people to capitalize. So I like them, and I put them down in the future, in their Future Is Now portfolio, because it's compelling. It's a compelling value play in a market with very few value plays. So that's a good one. I like them a lot. And this net is good also. We sold the 35 puts. So basically I'm saying, again, 5 times P. I find this a very compelling valuation. I'm not afraid to be assigned 500 shares of Cowen. But the net of the trade is only $1,250 of the spread. It's only a $5,000 spread. The Future Is Now is a much smaller portfolio. And it's just a pleasant little thing, and we'll keep an eye on it. They only have the options only go out to June. They don't have very long-term options, but it's a fun little spread, and we're going to see how it goes. And it's perfect for that size portfolio, and a little bit of a stretch to call it a Future Is Now stock because it's not like a new technology or anything, but it's a small investment bank that down the road is probably going to do very well. So I like it. All righty, so I'm gonna kill it here because frankly I have to do this I have to do a whole thing tomorrow, so I'm gonna be talking tomorrow. Somebody said the oil went back to 70. Oh wow, that did pop fast, right? So unfortunately, we're gonna have to if it goes over 70, we're gonna have to kill these two. We're gonna have to just end it there with a $2,500 profit for the day. It's not the worst thing ever, but it's unfortunate. And then as it goes over 70, if it comes back down, we can always short again using 70 as the in and out line. At 70.50, I would certainly buy again. I'd start shorting again. And then if it goes to 72, I'll double down. Because again, I don't see anything supportive for a rally here. And don't forget, like I said, we knew that 69.70 was a weak bounce, 69.90 is a strong bounce. We're at the strong bounce line. There's nothing unexpected about this. But if it keeps holding the strong bounce line and moves back over 70, then you can't pretend it's weak. You have to say, well, for whatever reason, it's getting stronger again. So that's why 70 is really a line. You got to take it off the table if we go over it. And I don't mean going over it for like a second. I mean, if it starts trending up over it, say forget it. It's just not worth taking a $2,400 profit and turning it into a loss. Doesn't make any sense. And of course, that'd be a $2,000 profit if we let it go to 70 anyway. All right. Thank you everyone for coming. I appreciate it. We're going to do this again tomorrow. We're going to have not so much extensive stuff though. It's going to be a little more focused. Somebody's interviewing me, and then we're going to do a Q&A after that. All right. But thanks everybody for coming. I appreciate it. Have a good day.